Jayson Crouch with Hague Partners. I'm here with Mike Motter, principal at Baker Tilly. Mike's a friend of our firm and had been in the industry for quite some time. And I know, Mike, you'll be able to introduce yourself in just a second. Some of the largest transactions in our industry are being worked on with Baker Tilly. So, Mike, good morning. Welcome to our podcast.
Morning, Jason. Thanks for having me here. Yeah, so yes, I've been in the automotive retail industry for quite some time, 30 plus years, of which 8 of them I spent inside the dealership, then going into public accounting. So I have a unique perspective on it. One of the things about Baker Tilly is we are the 6th largest CPA firm in the country with our recent merger with Moss Adams. It also makes us, if not the largest, one of the largest dealership practices in the country, working on 2,000 plus dealers across the country. So thanks for having us on today's conversation.
Thank you for joining. So we have a lot to talk about. The big, beautiful bill was signed in on July 4th, has a lot of benefits to the overall industry and to our economy as a whole. I understand a number of different things will happen. It's a long bill, and I know you're the guy to talk to about this. So in plain English, Mike, can you tell us what does this mean for us in our industry, for dealer owners, partners, and so forth?
So Jason, I'll start out by you're a pretty funny guy this morning. So we're dealing with the government and we're dealing with IRS code, and you're telling me to put it in plain English. That's kind of challenging, but we'll get in and we'll break her down a little bit. And I'm going to focus primarily on what this means for retail auto dealers. So we'll go into some business side transactions or some business side code as well as some individual, but how it really pertains into the dealership area for our retail dealers. So one of the big things that came out is I'll highlight probably 6 things on the business side. One of the big things is permanent bonus depreciation. So property that's acquired after January 20th of 2025 is going to be able to immediately expense 100% of that property, assuming it's personal property. Okay, so when you buy real estate, no, that's going to have to go over its normal 39-year life. But if it's personal property, furniture, fixtures, equipment, that can get initial 100% bonus depreciation. The good thing about it was when I talked about real estate that it goes over 39, if you were to do a cost segregation study, so let's say a dealer does build a new facility or upgrades, does a reimage, a lot of that can be carved out. About 30 to 35% of that total cost of the project can be carved out into personal property by doing a cost segregation study, which that means once it's carved and put at personal property, it becomes 100% bonus depreciable. So it's a nice benefit that a lot of dealers were looking for. So the other thing is increased Section 179 expensing. So 179 expensing has the same type of concept as bonus depreciation in that you can immediately expense that personal property items. The one difference is 179 is limited, so you can only have so much property put into service. So it's a struggle for larger groups to be able to use 179 because there are some rules as far as larger groups. You're maxed out at about $4 million. It starts to phase out dollar for dollar after that. But that has been increased to $2.5 million. The other thing is that Section 179 versus bonus depreciation. Section 179 cannot put you into any loss situation. So if you've got more Section 179 than you have taxable income, it can only bring you down to 0. Bonus depreciation can actually put you into a loss situation, which can be beneficial for dealers that may have some income to move forward in future years. One of the other big things was the Section 199A, and I'm talking technical terms. That's a qualified business income deduction. That's at 20% on flow-through entities. So if you're an S Corp or partnership, you get a 20% haircut on your taxable income. So let's say, for instance, your dealership is making $1 million a year taxable income. That $1 million flows through to the individual under the flow-through entities, S Corp or partnership. But when it gets to the personal return of the shareholder, it's only going to get taxed at $800,000 and not $1 million. That was a
Oh, that's great.
big, yeah, it's a big thing. I mean, when you look
Yeah.
at C Corp rates are at 21%, this was a way of bringing the S Corp into comparison with the C Corps when the C Corp rates were dropped to 21%. So what's nice about it, it does become permanent and it's 20%. The Senate bill actually had an increase to 23%, but that got shot down in the final bill. But it is 20%. We're glad we got the 20% deduction carry forward. Another area is the limited business interest deduction. So we call that 163J. So back in, well, when it first started back in 2018, that was based on EBITDA. So you got your depreciation and your amortization add backs to determine what was your adjusted taxable income. Under 163J or the business interest deduction, you can only take interest expense up to 30% of your adjusted taxable income. That was the EBITDA. In 2022, they changed it. They dropped off the D and the A, so the depreciation and the amortization were no longer added back. It had a significant impact on what dealers could take as a deduction. Under the new law or the new bill, we get that back again. So that effective the beginning of 2025, EBITDA is now going to be used for that calculation.
So that means that you can put goodwill back into the amortization piece, which obviously raises the ceiling for what you can deduct.
Exactly. Absolutely. So when
You
you
know, we
look
ran
at,
some numbers internally and we showed that just the 100% bonus depreciation, the timing of cash flows, being able to pull that up would increase an IRR for a buyer by up to 3%. So not only, and that's just like depreciation schedule versus depreciation schedule. That doesn't even include this higher ceiling of deductibility.
yeah, it's a great benefit and it's going to help dealers looking to sell because there's potential that the buyer is going to be willing to pay a little bit more because their internal rate of return is going to be better. So
Right.
yeah, it's some great
Right.
things. Um, a couple of things that kind of stink in the bill for dealers is the elimination of the alternative fuel vehicle refueling property credit. So as dealers were installing these charging stations for all the electric vehicles, they were able to get a credit for those. That effectively is going to be gone as of June 30th, 2026. So recommendation, if you still have chargers you need to put in, get them put in and get them installed before June 30th of 2026, or that credit is going to be gone. The other side of it is on the vehicle side. So there are two credits out there right now for consumers. One's the 30D credit, which is the new vehicle energy credit. The other is the 25E, which is the used vehicle energy credit. I'm not going to go into the details on what those credits, how they work and the amounts, but those are going to terminate as of September 30th of this year of 2025. One of the big things is, we've been hearing how the electric vehicle sales have slowed down pretty
Right.
dramatically and the prices are pretty high. This credit was a way to stimulate those sales. So if you have some units sitting in inventory, they're going to want to get rid of these things before the September 30th deadline so that the consumer can still have that incentive to get that credit.
So two things come to mind. One is we are seeing that in California where we had the ACC2 requirement. So we were pushing to 35% EV vehicles starting in 2026. And that has since been suspended or pushed out, right? So now ACC2 technically is gone and they're going to come up with another transitional plan. But those credits on the EVs, we're now seeing a huge marketing campaign because obviously, they're going to go away. And in California, we had a lot of them. We have probably the highest percentage of EV vehicles in the country here in, California, but the demand is still at that same point where it needs to be incentivized. But to your other comment about the installed charging systems, if you have a dealership that's already sufficient, has the switches, has the charging stations meeting OEM compliance and your customers' demand. Sounds like that's a great added value now because that deductibility could go away in 26 and you're already baked in.
Yes, yeah. I mean, you think about it, if a dealer is buying, you don't
Mm-hmm.
have to do that at a higher cost now going forward after the September 30th deadline. I'm sorry, after
Yeah.
the June 30th deadline.
Right. 2026. Yeah. All of a sudden, those values are now cost to do that has gone up unless the factories are going to incentivize it, which means that the value of your dealership has just gone up.
Yes, it makes it better for the seller. If you're kind of like the re-imaging side, if your facility is fully re-imaged and in compliance with OEM, it's easier for you to sell. You've got more value for a buyer. Same thing with these charging stations. If you up to compliance and you've got everything all set to what the OEM is requiring, the value of your dealership is probably going to be higher.
Right, that's great.
All right. On the individual side, which could hopefully spur a little demand, is
Yeah.
they've now come up with a $10,000 per year credit for interest that you pay on an auto loan. So there are some limitations. It must be a new vehicle, cannot be used. Okay, so it's not going to help the used market, but hopefully it'll stir some demand for the used or for the new, I'm sorry. And AGI is limited to 100,000 for an individual and 200,000 for a married filing joint. So there are some limitations on it, but it does put it into the category that allows the typical consumer to get out there, buy a vehicle, and have that interest to be able to be somewhat deductible anyway. So that's a
Yeah,
nice
and
one.
what was interesting about this when I first heard it floated was that I thought, well, how many folks are in that category of income, but also, itemized, right? And then we found out when it passed that in fact you can use this even if you use the standard deduction.
Correct. Correct.
That's
And
fantastic.
what's nice, you pair this up with some of the manufacturers' interest rate credits, or not credits, but incentives, and you can buy a new vehicle at a fairly reasonable price given the financing side of it, being able to get a lower interest rate and now being able to deduct the interest expense on it as well. So it
Yep.
could spur some demand. The other big thing on the individual side was the SALT deduction, and everybody's aware that that dropped to $10,000. And not only does that, when I talk SALT, it's state and local taxes. So not only is it your state income taxes and local income taxes that you're paying, but it's also real estate taxes. So those two combined make up that $10,000. Well, for dealers, I mean, most dealers' real estate taxes are $10,000 alone. So they really get no deduction for their state income taxes. Well, that's now moved to $40,000. So that is a good thing. It does help out. The one thing was in the Senate bill that did not make it to the final bill was they were going to limit the pass-through entity tax where the corporation, the dealership corporation, could pay the state tax and get the full deduction on it versus allowing that income to flow through to the dealer's individual state tax. That did not pass. So that is still legit. It's still a great maneuver that dealerships should be doing. They should having, depending on what state, because it varies by state, but they should be having the dealership paying the state taxes so that they get the full 100% deduction on the state tax. Now, there is a little quirk in this whole calculation that when you look at somebody that's in the 500,000 to 600,000 AGI range, they could be, how do I want to say this? Whipsawed, because it could
Oh,
be as much as a 45.5% tax if you fall in that area. So real dealers really need to watch closely because after the 600,000, it's phased out. You back down to $10,000. So it's a limited to everybody under 500,000 is going to get the $40,000 limitation. Anybody between 500,000 and 600, it's going to be reduced down. Anybody over 600 is going to be at a $10,000 deduction ability. So if a dealer falls between that 500 and 600,000, you really got to plan things closer. You may want to look at advancing some income or shooting some income back to the following year if you can, because when you're in that range, depending on how things work out, charitable contributions, things like that, that you get to itemize, you could be stuck at a 45.5% federal tax on those dollars.
that's a very
So,
interesting nuance, and I'm glad you pointed that out because yeah, if you are right on the tipping point there, I mean that could be dramatic, and you can make some adjustments depending on where you land. But also
absolutely.
going back to where we were talking about earlier, from a demand side push for our industry, you have what we talked about earlier with the no taxes on certain things, and then you've got the additional opportunity here for high property state or property tax and state tax states like California, New Jersey, some of these others. I mean, we're going to see some relief for many, many customers.
Yes. Again, yeah, like you said, that could boost demand again.
Yeah,
So when
fantastic.
you look at throwing all these things together, there could be a really uptick in the new vehicle side.
Yeah, that would be great. Yeah, you add in the interest deductibility on some of these car loans, things like this. I mean, this could be really good all around, in addition to the business impacts that we've already discussed. So
Right.
overall, how do you see this bill affecting values and buyer motivation when it comes to automotive dealerships?
I think it's very positive. So, when I look at motivation, um, and the values, as we talked a little bit earlier, the bonus depreciation is huge, and it produces a higher IRR, internal rate of return, for dealers that are looking to buy. I have not yet met a dealer that does not like advanced depreciation. So they're always looking to take that higher deductibility early on, which is a smart business decision, and nobody likes to pay Uncle Sam. So when you look at that, does it provide a buyer the ability to possibly pay a little bit more for value and still get the same rate of return that they would have had they not? And I think, yeah. So
Right.
yeah, I think it there's a possibility that it could have some increased upside potential for valuations.
Yeah, I agree with you. And like I mentioned earlier, we did some calculations internally just looking at just moving the cash flows around from the depreciation and an increased IRR. That doesn't include the fact that you can increase some of your leverage to magnify the returns. Some of the things we talked about with the electric vehicle chargers in certain areas already being done. So it seems like there's a lot of great things happening here. What about, does it change the calculus for dealers thinking about selling?
I think it might. I think it brings additional demand to the market for buyers with this favorable tax policy. Um, it gives it gives some certainty. Whereas, the biggest thing that you have is the fact that you don't know where things are going to go. So people are a little nervous and reluctant to make a move when they don't understand
Right.
how it's going to affect them. What this tax bill does is bring some certainty to the market, which then opens it up a little bit to allow for a seller or a buyer to be a little more aggressive and to go. Um, it makes when we look at on a selling side, we've got the estate tax exemption out there that got permanently stated at $15 million a piece. With that, it gives them some certainty as far as the exemption credit that they're going to get when they sell, and it provides them an estate planning opportunity, and says, hey, you know what? Maybe if we do this now, we can do it in a certain way so that we can use up some of that exemption that's higher. None of these, they all say they're permanent. Okay, but let's be clear. The government is consistently changing, and we don't know with the next regime in there where things are going to be. So they say it's permanent, but it's only permanent for probably the next 3-4 years. Okay, so things have to get changed out, and they could potentially change. So now is the
I was going to ask
time.
you that earlier when we started talking about permanent changes. So yeah, permanent meaning for the next 3 to 4 years.
Yeah, it's permanent with this party. I mean, when the next party gets in, we don't know what's going to happen. So if a dealer is considering selling and is looking to benefit their estate, now is the time to do it. Now is the time to take a look and say, hey, I've got 15 million locked in guaranteed, or 30 million, and it does increase with inflation. So there's an inflation index every year. Um, but I think, like we talked earlier, sellers benefit kind of indirectly due to the fact that the buyers may place a higher value because of the depreciation, because of the internal rate of return that they are able to obtain because they've got the higher depreciation deductions now.
It's interesting is at the beginning of the year when we first turned 25, we started thinking that, we had more consistency in earnings. And so maybe the gap between what sellers were expecting and what buyers were willing to pay was going to start closing. And so we'll see more deals kind of hit and go through a little quicker without the dislocation that we saw when we had the earnings disruption for COVID and so forth. So we thought 2025 is going to be a lot, I guess, more efficient from a transaction perspective. Then all of a sudden the tariffs and the uncertainty and the rates didn't come down as fast as people thought they would. And then, they started coming down on the commercial side with the Fed funds rate, but not necessarily on the retail mortgage side. And so then there was all this out there. What we noticed, to be honest, was sellers were a bit apprehensive. So sellers were pausing. There are deals out there. We've talked to a number of buyers. Well, they'll talk about a little bit of deal fatigue around some of the stores that are not performing well, right? So, okay, I'm seeing somebody bought something that maybe doesn't fit their platform well, or is, maybe just not in the right position right now today. And so there is a little bit of fatigue around that. But for quality, strong brands and good locations or great operations, we're starting to see that there's less of those out there because the sellers have paused due to some uncertainty. So what that's created for the right asset is very much a seller's market. There's a lot of buyers calling, looking for things, and some of the great things aren't out there yet. So we're when we have brought great assets to market, we're seeing fantastic demand for them and a lot of push on value. So it's very interesting.
Awesome.
So this, to your point, does create some certainty in one segment. If someone's looking to do something in the near term, that sense of 3 to 4 years of permanence is great, right? So
Correct.
on the buyer side, what should buyers be doing right now?
I think they need to be relooking at all their deals. I mean, they need to take a look at them and say, okay, how did this pan out prior to these changes, and what do they look like now? Is there ability to get the same IRR and pay a little bit more, even though buyers don't want to pay anymore? We get that, but
Right.
it's going to be a competitive market. So in order for them to get the deal they want, they may have to pay a little bit more to get that same IRR. So. And I think they've got the ability now with some of these tax deductions to come through. Some of the things it's obviously it's opposite buyer versus seller, but the buyer
Right.
wants to be focusing on putting more of their dollars in the transactions towards your fixed assets or your personal property, just because you get the 100% bonus depreciation on it. So you want to get that in there. And you want to take a look at, how are some of the interest limitation rules going to affect your transaction and your borrowing bases to make sure that they understand it. Is it better now? Yeah, it is. So they need to review their deals and take a look at it. If they were sitting here, they may need to adjust it a little bit or take a look at it under the new tax laws.
Just make sure that they're updating their model accordingly, right?
Absolutely.
Yeah. Yeah, we did hear of another dealer who has been acquiring through the years and quotes that he's discussing himself. He says, we don't feel like we're not aggressive when we go after deals. Like we pay all the money to get the things that we want. And in his particular conversation, he was saying that they missed out on some things that they really wanted. And so he was surprised by it. But at the end of the day, that shows everything that we're seeing here. But, in terms of like making sure that folks are adjusting their buy model, but also the demand for quality assets when they do hit the market, they're going quickly and they're going for great values.
Yeah, I think it's going to be a competitive year again.
Yep. Yep. Once again. So any unexpected winners from this bill that we haven't already discussed?
Well, we've discussed it all a while. The dealers. I mean, they are the winners in this whole deal. I mean, businesses in general. Dealers that when I think of the depreciation, dealers that have recently built purchase facilities, reimaged their facilities, they're the ones that are really going to benefit. Assuming it's been done after the June 20th date line, or ones that they're finishing up facilities now, because it's when you put that facility in service is when you get to take those depreciation benefits. So yeah, they've really won out well. Overall, consumers with the SALT limitation, being under that $500,000 income, if you fall in that category, that's just some added money into your pocket. I mean, it increases disposable income, which
Right.
allows, again, dealers to be the benefit because it allows the consumer to go out and buy a vehicle. Whereas prior to this, they may not have.
Yeah. So hopefully what we see, I know that some factories have talked about the lack of vehicles in sub $30,000 range, right? And
Right.
so maybe some of these changes, the deductibility of auto loan interest, the tax impacts of SALT, maybe some of the non-taxable income categories now, like tips, things like this. Hopefully all of that can kind of like push some consumers over the threshold. So we can see a lot more demand pull on new vehicles, used vehicles too, when they, in terms of certain income impacts that we talked about that are, those are going to be agnostic to new or used, right? Maybe we'll see some demand push there, right, for our
Right.
industry. So that, of course, increases cash flow for everyone at the dealer level. And then some of these benefits here, whether you're buying or selling, fantastic opportunities for increased values, increased demands. And so, yeah, it's all great. So thanks, Mike, for joining
bet.
us, because I know that it's over 1,000 pages, and we appreciate you taking it down to a level that all of us could quickly understand. And I guess at the bottom line, no matter what, I mean, what we've talked about is pretty straightforward and clear the way that you've presented it, but it's a lot more nuanced than that. And so at the end of the
It
day,
is.
you call your CPA and make sure that you're clear as we kind of move forward.
Absolutely. Jayson, thanks for having me on. It's always a pleasure having a conversation with you.
Yep. Thanks so much, Mike. Appreciate it.